and its implication for capital markets. Personally speaking, investment gamification was a new term for me, but with the further reading I did, was surprised to know that there are practices that we come across on a daily basis and most of the time unknown to us has the ability to change our behavior, especially when it comes to investing. Therefore, I believe it is high time that we are familiar with these topics and practices and are armed with the necessary knowledge to take informed decisions. And I believe today's session is aimed exactly for that purpose. And I would like to warmly welcome our esteemed speaker, Mr. Pankaj Sharma, Manager, CFA Institute India, to share his valuable insights with us. He will take us through a very insightful presentation, and afterwards, we will move on to a discussion, including questions the audience may have. Over to you, Pankaj.
Thank you so much, Natika. Uh, this is a this is an honor and a great pleasure for me uh, to share the insights and the experience which I have had with gamification. As Natika said, that this was a term which was not very familiar even to me a couple of years back, but as we understand, and these are the examples which we encounter on a daily basis, is something which impacts all of us very regularly, and that makes it very relevant and extremely important for us to look at and understand. I put together a few slides and share that presentation. But as I said, like I'm extremely thankful to CFA Society Sri Lanka, all the like Aruna, Narika, everyone who have contributed in guiding me to make this exercise, make this presentation, make this interaction useful to the audience and to every one of you. In case you have any questions or if in case you have anything, please feel free to ask those, and I would be more than happy to answer them as much as I can. I'm not committing that I will have all the answers, but that's how it is. I'll try to answer as truthfully and as honestly as I can. And also my sincere apologies because I have a sore throat, so my voice is a little hoarse, and do please apologize me for that because uh, this is something which happened over the last few days, and I did not have really any control. Though I was drinking a lot of warm water, but it still didn't help too much. Anyway, like without further ado, I'll just share my presentation with all of you, and then we can start. Yeah. So I hope you guys can see my screen now. Uh, is it visible to everyone?
Yes,
Okay.
it is visible.
Thank you, Nari. So this is the topic for today, and this is what we will talk about: uh, gamification and investments. Uh, Usually, people see this. Uh, there's some kind of contrary behavior between these two. Games are for pleasure. Games are for your entertainment. Games are for your leisure time. And investment is a serious business. Investment is a thing which you do for your future planning, for your retirement, and to making your future more secure and safe. And when these two streams come together, it makes two very important parts. One is a little bit more serious, investments and savings and how it flows to the different avenues which you have for investment. And second is the games, which is a stream which deals with more of leisure and more of your free time and more of your activity, which is dedicated for your refreshment and for your leisure time. So, what are the implications? And when these, as I said, when these two things merge, what could be the implications for capital markets? This is a topic which is relevant for very important reason, that is, it has a huge impact and huge implication for small investors, because large investors, especially institutional investors and the ones who manages huge amount of kitty, these people will be in an investment profession. So for them, it's a 24/7 job, or at least a 8 to 10 hours kind of a job. But for small investors, for all the people like us, it would be a job which will not take up 8 to 10 hours, which will be a part of their daily routine. And that is where the impact of gamification could be significant on small investors in terms of its uh, good things or bad things it might do. And CFA Institute, as an organization, has looked at this in detail for last many years. And personally, me focuses on capital market policy, research, and advocacy efforts in India. I have looked at this from different angles and from different perspectives in my tenure here, very, very closely. And even before I joined CFA Institute. And I am responsible for advocating positions that affect capital markets. And that makes me more interested, and that makes me more uh, like in terms of my understanding of these issues a little better, because I interact with different stakeholders like industry, regulators, and different people who are stakeholders in this particular aspect. So it is important for small investors, and CFA Institute has been looking at these things for a very, very long time. And this is a continuously evolving topic, and we keep updating ourselves on what is happening in this space. I have structured this presentation into 5 or 6 different parts. We'll start with an example of nudge. A nudge is it's a behavioral change agent. So let's say when you don't want to push someone hard, and when you don't want to really make a law or regulation regarding something, you will try to change people's behavior by incentivizing them either tangibly or intangibly. So that could be a broader definition of nudge, but it's a very important catalyst and very important agent for change in behavior. And that could lead to significant implications. So we'll start with an example of nudge. A little bit about CFA Institute India. I cover the kind of work which we do and the kind of initiatives which we are taking. And then we focus on investment gamification, the components and the different parts. Then, because it has a theoretical basis, but at the same time, practical implications are no less important. And I will look at how the retail investors' participation in Indian market has very strong linkages with gamification. And then we look at some of the suggestions and recommendation in terms of the like how we can make the process much better and more efficient in terms of disclosure, in terms of other important areas. So this is what the structure of the presentation is. And the example of nudge is, let's say, in many countries, including Sri Lanka and India, cricket is a popular sport. And when you involve cricketer in something, whether it's brand endorsement or even social message, the reach and the impact magnifies. So in India, the mutual fund industry worked on a very intensive campaign. It was called Mutual Fund Sahi Hai, means mutual funds is right for you. And they used celebrities to communicate this message. And they use sports like cricket, tennis as a backdrop. And they use celebrities like I'm sure that you're familiar with Tendulkar, MS Dhoni, Rohit Sharma. These are popular cricketers and they are well-known cricketers. And these cricketers were used in their messaging. So I have put a few images of that campaign. Basically, it talks about that Rohit Sharma has forgotten his phone in the bus which the team is traveling in. Then Sachin Tendulkar comes and says that this is the phone which you forgot there. And then MS Dhoni pitches in by saying that this generation has not really planned for the retirement. And Rohit Sharma responds that no, I'm also doing what everybody is, which is mutual funds. So I'm investing in mutual funds since very beginning. It was a very simple message, very effective message, and involving 3 celebrity cricketers. So like, I would say that in India, if somebody is following cricket, that number would easily be in, let's say, 600 to 700 million people at least. And you will not find many people, even 5%, 10% people who will not be a fan of any of these cricketers. So some of the older generation will be a fan of Sachin Tendulkar. Somebody younger will be definitely following Rohit Sharma, and somebody in between maybe a follower of MS Dhoni. So use of these three celebrity cricketers in communicating that for even ordinary people is better to plan their investments and plan their savings using mutual funds is the right thing to do was a very impactful and powerful and effective message. And not just this audiovisual, which was created for broadcast media, but even otherwise, like this is the image which you see that this is from a cricket practice ground. And there was also some visuals which were there from tennis court and elsewhere. And these campaigns were designed to effectively communicate this message. And this tagline, mutual fund sahi hai, has not changed for last so many years, at least for last 7, 8, 10 years since the time this campaign is on. This tagline has not changed because it's worked so well. We'll talk about how the numbers look like in terms of the growth in asset management and industry. But the idea is that linking investments, which is the more serious kind of concept with cricket and with games, worked very, very well to communicate this message. We talk a little bit about CFA Institute India. We are today the biggest level one contributor globally. We contribute on like the CFA level exams, which happen 4 times a year. We contribute almost 4,000 to 5,000 new level one candidates. And these are the people who are getting into this field because they're interested in a career in finance and they see great value in what CFA charter holder can add in terms of their career prospects. And that is something which is leading to a lot of interest, lot of people taking up this exam and dreaming and thinking of a future which is focused on a career in finance. Today, we have around 4,000 strong charter holder community. Globally, CFA Institute has almost 200,000 plus, but in India, the community growth is very, very strong from, let's say, a number which was much smaller 10 years back to a 4,000 strong charter holder community. It has been a stupendous growth. We organize almost 100 events every year, and we are also a global talent source for the organization in general. One very important thing which we do is that we are a strong impartial voice. So like whenever we talk to stakeholders like regulators, policymakers, they consult us on issues where they need advice and perspectives which are impartial because we are not representing any particular industry. We are not voice of asset managers. We are not voice of brokers. We are not voice of anyone. Like we represent everyone, but we are not partial in terms of what we'll tell and what like our view and our thought is very, very impartial and very, very objective in terms of what we are going to suggest and what we are going to recommend. And this is something which is very important in taking a leadership position in thinking, thought leadership, and the change and trends which are being observed in capital markets in India. This is a growth market, and there are a lot of changes, a lot of evolution which is happening at a very rapid pace, and we are doing our best to keep pace with it. Now, come to the topic which we have for today, investment gamification. So, when we see this topic, this is important for us to remember, as I said, that the basic concept is very, very simple. The concept is that gamification implies that when you bring in the basic concepts or basic elements of game means sports could be indoor games, it could be anything where there is a characteristic involved, like somebody will win, somebody will lose, there is competition, there are defined rules of play, and there are definitely a recognition for you if you win. So let's say if even if we have not played any sports professionally, all of us would remember that in our childhood, whatever sport we were involved in, whenever you win uh, an event or a match or a game, you always feel good about yourself. And that's something which is a very important fundamental of this entire gamification, which is being seen in capital markets and in investments. And this is a use of such behavioral techniques in investments. And not just investment, this is being used in education. And of course, you would have heard of this concept that, like, if you are telling kids and making them learn something, involve them in the process. If you involve them in the process, they will learn faster and they will remember for longer. And this is because they, as kids, once they become involved in a process, they understand the concepts more easily. And even the most difficult concepts, like why the kindergarten classes, or maybe the smaller, like first or second standard students, you will find a lot of gamification even in their learning today. And that's something which is a very important implication and very important application of how gamification principles can help. Then there are healthcare areas like financial services where gamification has been applied. And that's a very important trigger for a lot of industries in making them more attractive and making them more remunerative for the customers and for the new investors like financial services they're entering these people to come in. And the one basic idea is that, as I said, gamification introduces the fun element, which was missing from investment, which was seen as a serious business. So usually you would see that the, like, typically older people would talk about investment advice 30 years back, 25 years back. But if you are to involve the younger generation, and demographics plays a very important role, and some of the countries like Sri Lanka, India, and a lot of Asian countries, where the demographic is such that if you have to involve the younger population in investments, you have to bring in some fun element to make the learning easier for them. And this is also important for two reasons. One is that when you see that typically the people who are entering the workforce, they would be, let's say, at 21, 22, 23 years of age, when they enter the workforce, or even 25 years of age. For them, it is much easier to save because they have much lesser responsibility. And that's something which, if you introduce them to a saving behavior or investment behavior, they are more likely to be sticky customers for you. They will stay there. The lifetime value of a customer who stays for you for 25 years or 30 years or 40 years is much larger as compared to somebody who gets in the system at 40 or 45 years of age. And this is important for making them better prepared for future. And that is why the gamification of investment and the behavior which I was talking about is going to be relevant. Again, it's a great thing. It makes learning fun. It makes them more engaged, more involved. But it also has pitfalls. It also has challenges because the same techniques can be used by the firms which are in this business. So let's say you are a brokerage firm and your business model is linked to how much trade people do, how many times they trade, what is the size of their trade, and those kind of parameters. Your incentive is that people trade more, you make more money. And if you bring in gamification elements, if you bring in these kind of behavioral changes in people, that's advantageous for you. That is better for you. That is making your business more profitable. And at the same time, it is leading to excessive trading and also trading in complex or high risk products. So, for example, when we look at derivative instruments, futures, options, these are not simple instruments. These are not like you buy a stock and you hold it forever, the buy and hold strategy, which typically you have. You don't have much risk because the maximum loss which you can undertake is the amount of money which you have invested in. So I'm not saying that that is the ideal situation, but still, it's much better than a situation where complex instruments are being traded, where people have no idea about the loss potential which could arise. And there have been examples in the past, so like I don't know how many people would have heard of this name called long-term capital management, LTCM. But LTCM was a firm which was in late 90s, was started by some very bright people, Nobel laureates, and very good people and very capable people in terms of their understanding of investment business. but the firm failed because of, like, of course, a very long story, and there is a very nice book on that. But the short answer is that the firm failed because the people who are running that firm were not able to forecast the tail risk, or to forecast the risk which they are undertaking when they are investing. And a lot of these situations could be very similar when small investors are trading in these highly complex instruments. These are high risk products, these are complex instruments, and if without proper awareness and proper information, if somebody is investing in them, that's not a great thing to do. So, all in all, this will increase harmful behavior and chances of losses, and the chances of people losing money for a very long time to come is a clear risk which we can see because of gamification. And all this is because some people, some businesses will have a perverse incentive in making people trade more, making people trade in more complex and difficult to understand instruments. So, one part which everybody will tell you about, that this is the loss, sorry, this is the profit potential, but what risk it entails, what could be the loss potential, that will not be disclosed, that will not be discussed. And that's something which is not fair. Now, how this has played a role in gamification, it's very important to look at the digital engagement aspects, like with data being so cheap and with access to smartphone to almost everyone, it has given a very strong support to gamification, because the firms which were in this business and which were using gamification techniques for investors and for people to use and try their products, they found that smartphones, access to data, better connectivity, better network, all has helped tremendously. And that is something which has also led them to create a very dynamic environment. So you will see leaderboards, you will see who is at the top, who is winning, who is losing, and that gives you a very strong trigger, very strong catalyst for individual investors. When somebody sees their name at the top, they would feel very good about themselves, and that will probably induce them to trade more. And that is something which is a very sophisticated reward system. And a lot of these companies would use that to induce more investors into their platform and to make them trade more. And this will also not just the technical aspects, but the ease of navigation, how attractive the app is, how attractive the user interface is, how convenient and easy it is to navigate that, and what are the information notifications which are appearing on a screen. So let's say if you make a trade and the stock is going up, if immediately you start getting messages that you have earned 500 rupees, you have earned 1,000 rupees, you will be getting more and more hooked to this behavior, because you can immediately see that, okay, like half an hour back I invested and I have won 1,000 rupees when the stock is going up. So all those kind of notifications, all those kind of changes, and the user interface and navigation which is there on an app, on a platform, it has made people very much comfortable for them to trade. It's made them not just like the product, but they are also hooked to the product, because it's a great way of spending their time. It's a great way of spending their afternoon when probably they're working from home and they're not doing much. So all that, even for students, let's say when you look at the students, they would see that, okay, they have a class which is free, which is not there much for them to do. They would probably get onto that platform, get onto that app, and they will start doing these things. And even if you are not trading, but when you are just doing some mock trading, paper trades, and all that will appear on your screen, and that makes you feel very good about yourself. And these are also, this is one part, but at the same time, a lot of these companies and a lot of these businesses, they have also worked on reducing the frictions. Friction means how difficult it is for you to trade, how difficult it is for you to, in terms of the extra cost which you have to pay. So let's say if somebody is introducing a zero commission trading, it will of course be good for a trader, for an investor. And when you look at fractionalization of shares, so for example, if a share is very expensive and you offer like you can own 1% of that share, you can own 10% of that share, you can own 5% of that share, it makes the cost of ownership relatively cheaper. And of course, it's an indirect way of doing stock split and all that. Like it's the same concept. The volumes go up when stock splits, and when you have more volumes available, more trading quantity available. But the idea is that while everything has been worked upon in terms of making the apps attractive, platforms much more ready for people to invest and all that, but at the same time, it has also been seen that the companies and the trading platforms have invested in making the friction cost lower so that more investors are getting. And at the same time, you have seen that there is a strong marketing push, a lot of celebrities, a lot of people pushing that product. Advertising is huge, distribution is huge, and all those things are leading to more and more people getting hooked to these platforms, getting hooked to these investment apps and other possible avenues. Now, when we see that this is something which is like one of my favorite quotes is by J.M. Keynes, and he says that we devote our intelligence to anticipating what average opinion expects the average opinion to be. This is how the market works. If you are buying a stock, you are thinking that everybody who is selling this stock is wrong. Because if they are not wrong, then you are wrong. So if you are buying a stock, you are thinking that everybody who is selling is wrong. Similarly, if you are selling a stock, you would think that everybody who is buying this stock is wrong. So basically, the stock market works on this principle that you are trying to guess the average opinion. And when somebody says market is expensive or market is cheap, it's about the average opinion of that market. And you are trying to outsmart the crowd. And that is where this social angle comes in. And why I say that this played an important role, because at the time of COVID-19 pandemic in 2020 and later, people were looking for an activity which will keep them a little bit distracted. Because the times were very difficult. It was a very depressing time for people. And they were looking for avenues where they can channelize their energies and time in a more positive way, in a more constructive and creative way. And this led to people looking at some of these apps and investment platforms which were offering them a better interface and use of gamification elements to make them feel good about how they're spending their time and what they're spending their time on. And I would say that this is a very important trigger and it's important threshold. Prior COVID and post COVID, we have seen a strong change in the behavior of investors and behavior of average traders. Then there is a social validation angle, which I have spoken about. It's a situation where you would look at that how you're performing versus the peer group which you have. And it could be a different motivation. Like it is often said about the markets that if you ask someone where they invested, they will also talk about their trades which are winning trades. They will never admit about the losing trades which they made, which means that social validation, that everybody is trying to look smarter in front of the peer group, in front of the people they're interacting with. And they will talk about their successes. They will talk about their stocks and trades which they have done well on. They will not really spend that much time. It's not about being honest or dishonest. It's about highlighting things which you feel more comfortable about sharing. So when you talk about your winning trades, you are giving a signal, you're giving a message that you are a brilliant investor, you are a smart investor, and you have made that trade, you have made that investment, which has done so well. And this ultimately leads to a form of addiction. At times, what happens that once you are continuously looking for validation, it becomes an addiction because it's like very similar to when you upload a picture, when you upload a story, you would be looking at how many people are liking it, how people are commenting on it. And this is very, very similar situation to that. You will be looking at the social validation, how people are reacting to your information, how your peer group is reacting to that. So all that which is related to social validation could lead to an addiction where you're continuously looking for dopamine, that how this entire thing is behaving, how this entire thing is impacting. When we see the needs and wants, we have to remember one thing, that investment is done with a purpose that is related to need. Somebody is saving for a goal. Let's say somebody wants to study further. Somebody is looking for important events in their life. Could be marriage, could be building a house. Somebody might be looking at a retirement. That is a need. That is a requirement. But when you add that social angle, the validation angle, it becomes a want. You are looking at a continuous inflow of social validation. You need that rush of dopamine every time. And that is something which could lead to a behavior which might be against the basic principle of investments. In investments, it might be better for you to adopt a buy and hold strategy. But when you are continuously looking for social validation, you want to see yourself at the top of the leaderboard, you might be trading more. If you make a mistake, you might say that, okay, I will trade more and correct that mistake. And that is something which could be a difference between what the needs of the investments are and what you as a social being might be doing as your wants. Uh, this is not just a problem in terms of how it will impact the investors or the small retail guys, it is also important for the structural risk for the markets because it has significant implications for market integrity. When you see that without any fundamental basis, if the stocks are running up, the markets are going up, and that could be the reason why the market could be more prone to a big crash. The market could be more prone to a big failure. And could be also the reason why some of the stocks where you might see an artificially inflated price. So it is all linked to the impact on small investors, but at the same time, it could also lead to the structural risk for markets. And that is something which is very important for us to remember. If the trust and faith in markets get breached, if it gets impacted negatively, that is bad for everyone. Everybody in the capital markets, not just investors, because if market will crash, definitely they will get impacted. But it's bad for regulator, it's bad for policymaker, it's bad for society, it's bad for country, it's bad for everyone. It's bad for global capital market system and global financial system. And as we have seen, like in the financial crisis of 2007, 2008, that was the case. Like the problems were in a certain geography, but it got extended so much to an extent that the entire world got impacted. So there are examples like in 2021, there was a massive failure of Robinhood. And that is something which was caused by the investor mentality and sentiment, which was driven by a very strong retail trend. And this is something which is an important point in my view because it is not just in futures and options and in cash market in the stocks, but it's also linked to some of the other areas like crypto and many of the other areas where there is a possibility of the quant-based system or contagion effects which might come into play. And there could be a problem in terms of how the market might get impacted structurally. This is again, we come back to the point that if markets are doing well, you're making money, that's good. But if for whatever reason, small investors get impacted and their investments become 50% of what they had invested in, and that could be the reason they might stay away forever from the markets. And that is something which is important because early experience. So let's say you might have seen in your childhood some of the irrational fears and irrational, like the beliefs you might have had, could be driven by the early experiences of that particular thing which you have had. Somebody might be scared of, let's say, milk because they drank milk which is very hot, and they had a problem. So I think they will probably in that situation get probably in a way that they would not like milk because they think that it will be hot and it might harm them. So it's very similar to the small investor, the retail people, because for them, if they get impacted and if they lose money, they might say that the stock market is not something they can trust. The stock market is not something they can understand. And that is a very important thing. And also, at times, the last point which you will see that there is an element of luck and there is an element of skill, which is important in investment decision making. And sometimes when you are too lucky, you might think wrongly that it's all because of your skill. And that might be a very, very different thing and very, very difficult thing for a retail investor because it might backfire. You might think that all of the gains which you have because you are a smart investor, but if all of it is coming because of luck, all of it is coming because the markets are going up, and when the market turns around, it always happens, you might not be able to handle the risk and the situations which might arise. So there are three important points. One is that gamification is useful, but at the same time, it has risk. Second, retail investors need to be careful about their trading behavior. And third, the market has a structural risk if this kind of behavior goes out of control. Of course, we'll talk about how to respond in detail a bit later. But the important thing for us to understand is that there has to be a structured thought process. Gamification is not something which can be rolled back because the use of social media, the use of gamification techniques are here to stay. So any kind of blanket ban, any kind of regulation which might lead to a complete withdrawal of that is detrimental. It's not going to work. So then we have to find ways and means to how to handle it. We'll discuss this in later. But before that, we'll talk about a case study, how this retail investor participation in India has panned out, and how this has led to a very strong participation because of gamification playing a very important role in it. Derivatives, which are futures and options, the growth has been huge in India among the retail investors. And despite the fact that most of these investors don't make money, and this has made the regulators and the policymakers very, very concerned. So this is the graph which you see on your screen. This is how the average daily turnover has grown in cash segment. Cash segment means like buying a stock, taking a delivery. So that cash segment has grown. Of course, the growth is very impressive in last, let's say about 16, 17 years. We have seen a growth of about 6 to 7x, which is very impressive. And if you compare it with the other constituents like options and future, the cash segment growth is almost nothing. So let's say if you look at the stock options, the growth is more than 30x in a matter of 7 to 8 years. From FY16 to FY24, the growth in options, both index option and stock options, which you see on the right hand side of your chart with the yellow arrow, the growth is more than 25 to 30x in a matter of 7 to 8 years in that market. And similarly, if you see the futures, futures have also grown, but not that much. So primarily the growth is happening in options market, which is far higher as compared to what you're seeing in the cash segment or what you're seeing in the future segment. When you look at this chart is astonishing. This table which you see that the overall market cap in India is around 3% of global. And it might be a little higher today because of the market, the way it has done, around 3.5%. But when you see the daily turnovers in option, the number is mind-boggling. It's almost 2.5 times of what US does. India's market cap is less than 1/10 of United States, and the daily options turnover is 2.5x. So like this is difference is at the scale of 25, 30x. And that is what is worrying the regulator and the policymakers in India. When you look at this is another number, which is data for April 2024, National Stock Exchange, which is the leading exchange in India, the index options which are traded in millions, that number is nowhere close to what you see in other markets like Korea, Germany, Taiwan, and other places. And this means that the kind of activity which you're being seen in this market is just very different as compared to many other markets. Then you see this the chart which talks about the linkage between why the turnover has grown and how the number of investors has grown. This chart which you see and the yellow arrow talks about the blue is the number of people who are investing in cash segment, and the orange is in F&O segment, future and options. And see the number. FY18 to FY24, the cash segment growth is around 4x, 72 to 307, around 4x. But when you see the number of the people who are trading in F&O segment is more than 10x, from 9 in FY18 to 96 in FY20. In a matter of 6 years, the number has grown more than 10x. And this number, when you combine it with the trades which are happening and the people who have grown and the numbers of investors which has grown, is mind-boggling. Now, what it means. When you look at some of the results, it's very depressing. SEBI, the Indian market regulator, has carried out a study which says that 90% of individual F&O traders, they lose money. 90%. So every 9 out of 10 investors in this market are losing money. And even people who are making profits, they are losing almost 15 to 50% of their profits in transaction cost. So effectively speaking, 9 out of 10 people, they make losses. Forget about them. People who are making profits, out of those 15 to 15, 50 to 15% to 50% of profits are going into transaction costs. So net, retail investors or the small investors are not making money. Now, when you look at some of the other data points, the loss making investors, whatever loss they are making, another 28% they are losing in transaction cost. So what it means that, let's say if you are a small investor and you lost 100 rupees in trading, F&O, and then another 28 rupees you lost in transaction cost. So your effective loss is around 128 rupees. What it implies is that a lot of these people have got addicted to F&O trading and they are losing huge amounts of money. And the significant loss of capital for a small investor. So, like somebody is losing 1 lakh rupees in Indian terms, which is more than around $1,100 or $1,200. It's a huge amount. And a lot of these people would continue to trade because they got addicted to this. SEBI and policymakers are focusing on this, even in the budget, which came day before yesterday. The transaction tax on F&O has been increased, and that is being seen as a small step in policymakers' view to curtail the trading which is being seen. And a lot of times the SEBI chairperson and the finance minister, senior finance ministry officials, they've spoken about the investment behavior of small investors, which is not healthy for them. And this is something which is a clear-cut sign that the policymakers and regulators are worried about this trend. Of course, there are plans in terms of increasing the margin requirement or other things, but I would say that so far, nothing seems to have been working. The interest of retail investors in F&O trades remain high. And of course, in some parts, it's also because of the fact that Indian markets have done well in recent times. So people are making money, and a lot of these people might have made money in cash segment. despite losing a bit in Apple, they would think that overall they are good with their market trends and their investments. And that's something which could be a problematic behavior and challenging behavior. And all of it is led to three or four important factors: gamification, reduction in friction cost in terms of zero trading cost and zero commissions. Then third important aspect was COVID-led change in investment behavior of people. These are three or four things which are very, very important in seeing and explaining the data which we saw in the context. Last 6 to 7 years, the kind of growth we have seen in individual investors trading in FNO segment, the number of trades which have increased, all that is attributed to some of these factors where gamification itself is a very strong component. Gamification itself is a very, very strong trigger of the change in investment behavior of people, and the investors who are small and in retail segment, they're trading more and more. They're trading in instruments which are complex, where they lose money, but still they are doing it. This is the bottom line of what we discussed about the example of gamification in Indian retail market. 9 out of 10 people lose money. SEBI and policymakers, they are very concerned, and they are trying to take steps which are very important. But still, as I said, like the market is such that all these steps which are trying to curtail the participation of retail investors has not been effective so far. And this market continues to grow, this market continues to expand. Now we come to the part which is related to how do we respond? And the response is related to some of the recommendations, suggestions which we have. The first and foremost thing is that the responsibility as a responsible business and accountability as a responsible business is also on the firms which run these apps and the platforms. And there should be a time to reflect and review for investors. For example, I say this was mandated by Indian regulator SEBI in India, that if you are investing and if you are logging into your platform, the retail investor, there will be a message which will display that 9 out of 10 investors make losses in Appendo, and you have to click on that. Means that I've understood it, I've read it. And it might not deter you, but still it is a small step of making people aware. Then there should be a reward and feedback system in terms of how the long-term investor outcomes are very different from short-term investment. So making money today, making money tomorrow is important, but making money on long-term basis without taking too much risk or without taking risk which is beyond permissible limit for you as an individual investor is extremely important. This is a very important saying in the market that take as much risk as you can, but be sure and that you are there tomorrow, which means that don't go bankrupt, don't go out of the game. If you go out of the game, then you are not playing tomorrow. So whatever losses you made today, they become permanent. Your risk tolerance should be such that you can look at some of these investments in a way that, okay, this is my risk tolerance, and I would invest only this much. Beyond that, I would evaluate, I would reflect, and then I would do that. Then also, there is an important part which is related to how credible the information is. So information from reputable sources, information from recognized third-party knowledge providers, that is going to be extremely important for this entire exercise. And that is something which we believe is going to be very, very important in making the impact of gamification in such a way that it's more positive than negative. Then look at some of the specific things like point of transaction disclosure. So for example, sometimes the language of disclosures is so complicated that people don't understand it. If you give it in a fine print and in a very complex language, very complex format, people will not understand and comprehend the risk associated. So it has to be explained in a way where people can understand it very, very clear. Even if it's not possible to give it in vernacular languages, it's important for the platforms to give it in English and in plain English so that people can understand and comprehend. Then you have to look at the important part, because most of the times these trades and applications are happening on a mobile or a smartphone. It has to be optimized, and the design has to be such that people can understand and comprehend what's being talked about. And there has to be a full transparency of everything which is being involved as such, not just reward part, but also the risk. Communications, labels, conflict of interest disclosure, and licensing requirement. These are the parts which are associated to the responsibilities of the firms and also the regulators and the policymakers. So, for example, the disclosure of conflict of interest has to be made mandatory by the regulator. Licensing requirement should be such that there has to be a difference between a general and personal financial advice. So you can say that save more. Save more is the general advice. Invest in instruments which protects you from inflation. That's a generic advice. But when you talk about specific instruments, when you talk about specific stocks and specific investment avenues, that would be included in the personal advice. And that is something which is going to be extremely important for people to understand and people to work on. Then there has to be a proper communication. Like there has to be a simple mechanism, for example, display that what is the risk associated, like is a simple meter, green and red. More red is more risk, more green is less risk. Those kind of things so that visually people can comprehend, people can understand. So these are some of the recommendation suggestions which CFA should have discussed and pushed forward. We believe that gamification is something which is an important initiative, is an important innovation, and that is going to be important for people to understand and make themselves aware about the investment opportunities. But at the same time, some of the risk and some of the problems associated with that needs to be addressed. And all of us stakeholders, including investors, platforms, brokers, regulators, media, everybody has to ensure that we work in the right direction so that the financial future of coming generations can be made secure. They have a future which is much better than what our generation is having. They have a future which is much brighter, which is much more financially safe and secure. And that is what gamification can easily be used. So I'll stop here for any questions. But in summary, this is what I want to talk about. Gamification, as I said, is here to stay, and if used well, it can help significantly. But all of us as stakeholders have responsibilities, and we have to work on this across levels and across avenues so that there are more disclosure related guidelines, and whatever you're getting into needs to be understood and comprehended by the people who are investing, including the retail investors. Thank you so much. And thank you once again, Radhika, CFA Society, all the participants and all the audience for your time and attention to listening to me. Thank you so much.
Thanks a lot, Pankaj. That was, I think I'm talking on behalf of the audience also. We are very much enlightened on a subject that is becoming increasingly important to the capital market participants. So I would encourage our audience to send in your questions either using the chat function or the Q&A function so that we can direct it to Pankaj. So until that's done, as a segue to our Q&A session, I would like to just maybe direct a couple of questions to you, Pankaj. I mean, looking at that advertisement featuring the cricketers, and I mean, these are something we see on a daily basis. And what I understand is it's a very thin line between, the normal, the traditional advertising or marketing we see versus like the gamification. So for a retail investor, are there any tips or anything you can give to, how do you differentiate that this is what gamification for what it is? If you can maybe give some pointers.
Sure. I think that's a great question, Adhika, because like how the advertising evolved, it was very generic. So, like for example, if you look at print media, we look at television, any broadcast medium, you don't know how the end user will engage with you. You have no idea about demographics, who will look at your ad, who will look at that particular TV program you have used for your advertisement. And then it evolved. So, like for example, what guys like Facebook, Google, and all those did, that they made the advertising personalized. So the kind of advertisement which you will see is directed towards you as an individual on the basis of your location, basis of your user history, basis of so many other parameters which are very specific for you. So this has been used very, very effectively by even the agencies and the platforms which are into investments because they know the whom they are dealing with. So let's say if you are advertising your platforms and if you are telling the audience to engage with you, you know who is on the other side. And it's not a blind advertising. It's not a situation where you don't know who is on the other side. You know what kind of user you're looking at, and then you will make your targeting, you'll make your advertising very specific to that individual, and that is something which has played a very important role. So this is what I said, like about how this entire thing has a strong digital component, because digital component has ensured that you can make your targeting very effective and efficient. And that is applicable not just for, I would say, investment platforms, but a lot of other products as well. Even for the consumer firms, even for a lot of other advertisement mediums, you have to find a situation where the user engagement is linked to the kind of quality which you have for your users. And that is something which has been used very effectively. So I would say that it is a very important component where you can digitally identify who is on the other side, and that you can accordingly tailor-made the offering and tailor-made the message for that person so that they get more attracted towards your platform.
Okay, that's very clear. Thanks, Pankaj. Again, can I ask the audience maybe if you have any questions to direct it, or maybe you can raise your hands and then we can allow you to ask the question. So if you do have anything, please go ahead. So also, in the meantime, Pankaj, when I was listening to the presentation also, there seems most of these gamification and all are directed towards like more complex, like, products, like, the options and all that you were talking about. In that kind of context, expert advice, like, the investment advisors, that role, how do you see that role panning out with these kind of, um, uh, influencing coming into the investment making process or decision making process?
I think that's a very strong distinction, Narika, and I think it's a great question because I would say that the need for expert investment advice is even higher today. Because as the products get more complex, as the user interest in these products, so like for example, if you imagine the situation 20 years back, most of the people would not even look at stock market. They would look at fixed deposits or like the term deposits, which were the popular options from banks. And you don't need to really think too much about that decision, other than the fact that what is the time duration you want your investment for? Whether you're investing for 1 year or 2 year or 3 years, that's enough. But today, when you have situation where the products are more complex, let's say if you're interested in investing, let's say in cash market only, what kind of investing you have to do? Index investing, ETF investing, direct stock investing. When you look at F&O, of course, I would personally recommend that retail investors should stay away from F&Os. But if somebody is interested in F&Os and making an attempt to understand that market, they need to be very sophisticated in terms of their investment approach. And that will require support and help from experts. And that is where the investment advisors come in. So a lot of times the it's always a saying that poor advice is cheap and effective advice, good advice is expensive. Because poor advice will not cost you tangibly, like it will come for free, but it might lead to losses for you which could be multiple times more than what you would have paid for the investment advice to a reasonable guy or to an expert. And that is something where I would say that there is a very strong differentiation between the generic advice. People can say that this is good, this is bad, but whether it works for you, as I said, like we talked about risk tolerance, and that is very important for people to understand that somebody who is young and just entered workforce, don't have too many responsibilities, probably they can take more equity exposure. But somebody who's, let's say, wants more predictable income, have more responsibilities, they would probably want to stay away a little bit from the market fluctuations. They would probably want a little bit more of debt in their portfolio. So I would say that what will work for you and what will not requires investment advice from an expert, an investment counselor who is registered, who understand the markets, who understand these different products. And that is something which is, it will cost you money, but it will be much more useful for you on a long-term basis. So I would say that there is a very strong need for strong, specific expert advice in investment. And as products get more complex, the need is much higher.
Okay. So I guess as a society and as the capital market participants, we all have a higher responsibility now to get everyone educated in terms of
Exactly.
these and
I
also
would probably
advice.
say, Nagada, that like this is something which at least I would say that people like us need to take very, very uh, responsibly, and we need to be accountable. We need to be responsible in what we recommend. So let's say if somebody comes to you and asks for an investment advice, you would probably, if let's say you think that you don't understand a subject that well, you would have no uh, you would have no embarrassment and no hesitation
Mhm.
in saying that, okay, I will recommend you to someone who understands this market. And if you understand a product well, you would probably ask them questions about what you want, what is your risk profile, and all that, and you will try to judge them, and then you will advise them. Like I
Mhm.
would say that if somebody comes for an investment advice in a particular stock to me, I would say that you better invest in an ETF because that's much safer for your investment needs. So
Mhm.
I would say that it's not a generic advice, but everybody in capital market ecosystem, people like you, me, and everybody else who is maybe part of the audience as well, they have a responsibility that they advise people in such a way that people get more encouraged to invest, but encouraged to invest responsibly, not in a casual way, not in a very exploratory kind of a way, an adventurous way, I would say.
Okay. Understood. Again, can I check whether anyone has any questions that they would like to direct to Pankaj at this time? Okay. So Pankaj, so if you take the local market, especially, I mean, we don't have a lot of complex products in the market. And also, I would say gamification to an extent is not as advanced as I would say in like a more developed market. But now the regulator has already brought in some requirements where, you know, you can anonymously make a complaint about if you see something like that, some social media influencing or something like that, you can make an anonymous complaint. I guess at this stage that works, but over time you touched upon some of the recommendations. But for a market that is getting there, what do you think they should proactively do at this juncture?
I think that's very important because I would say that uh, the first step for any regulator and any policymaker on this is to admit that gamification, no matter what level it is today, is going to grow, is going to get more important. And this is a process which is irreversible. Uh, at what pace it will happen, it's difficult to forecast and depends on the local context, depends on the what instruments are allowed and how other things will evolve. But it's an irreversible process. It will continue to happen slowly or in a fast way, but it will happen. That is one. So it's good that regulator is recognizing that people can complain anonymously and people can highlight the issues which are there. That's a great thing. Also, there has to be a mechanism to differentiate between what an allegation is and what a credible complaint is. So a lot of times it happens that sometimes the complaints and the issues are very frivolous. So like if I lose money after investing, I would blame my broker. That's not the right thing, right? I also have a responsibility in understanding the risk associated and the kind of instruments I'm getting into. And that's something which I really can't blame my broker on. I can say that this was not disclosed to me, that's fine. But ultimately, the responsibility is mine. What kind of instruments I invested in, that is one. Second thing is that, as I said, that disclosure is extremely important. So if you ask the platform provider or the app provider to disclose the risk associated. So let's say you say that, see, if you trade once every day,
Mm.
lose this much in commissions in 1 year. If you trade 3 times a day, this much commission you will lose. I'm saying that ballpark figure, if you explain, if you tell people that more trading is good for the broker, more trading is good for the platform, those kind of disclosures. And when you talk about an investment, as I said, like when you talk about some of the riskier instruments, there has to be a visual method to explain the risk associated. So, like high risk products, not suitable for, let's say, 40 plus population or 50 plus population, those kind of things in a simplified manner. There could be a there could be a problem in terms of investment product. But if you explain it well, if you disclose properly, if you allow the platform and investors to interact in such a way that investor is fully aware of the risk associated and the rewards involved, I think it's going to work better. So, of course, everything else needs to be done. It's a great step and it's a great beginning that there is a system in place which allows you to complain formally about a product or about something which you think is not right. But at the same time, simultaneously, if you work on making the disclosures more robust, I think that's going to be very helpful, extremely useful.
Okay. That's good to know, Pankaj. Um, uh, in the absence of any questions, I mean, lastly, I would just like to see influencers are playing a significant role in our decision-making process on a daily basis, right? And now it's quite common in the capital markets as well. And they have a more like a more sophisticated term, finfluencers. So in your opinion, like, should that be regulated? And to what extent should that be regulated, if so?
I think that's a very relevant question. I think not just in local markets, Narika, but globally, it's something which uh, we have been talking about. The CFA Institute, there was a very extensive research report we published on some of the trends and some of the issues related to that. There is also a very strong push from local regulators in India about how the influencer community need to be regulated and the associated challenges. My sense is that we have to strike a balance between two things. I would say that influencers have played a very strong and important role in making people understand the products and the investments in a simple language. I would credit a lot of influencers for that. That a lot of people who are investing in markets today, a lot of people who are coming into markets and investing in these products, they have understood their basics from influencers, from YouTube, from wherever. By the same time, what is also important is that the business model of influencer needs to be more clear in black and white, and it needs to be known to the people who are accessing that content. So if I know that this is a influencer I follow, and this is how he or she makes money in terms of, because it costs time, it costs effort, and there has to be a proper commensurate remuneration available for that influencer if they want that, and how they're making money. If I get to know that this has been disclosed properly, so let's say if they are advising me to buy a product, is there an incentive involved for that, or their advice is completely objective and impartial? If they disclose that, okay, they are getting this commission if I convert and if I trade with them, is fine, because at least they're disclosing. I'm saying that with my eyes open, I'm getting into that product and I will buy it. But if there is something which is gray and which is not disclosed, that is a bigger challenge, I would say. So my sense is that they have played a very important role in making people aware, spreading information, spreading it right way. But if the incentive structure about the business model and why they say what they say, it becomes more clear from a commercial perspective, I think that will help a great deal in making this space much better for everyone involved.
Okay. Understood, Pankaj. I think, I mean, at the end of the day, that transparency, that integrity, all that comes in. I mean, these are not in illegal practices, but as long as it's done with the integrity and the transparency, I think everyone benefits. I think this has been a very insightful session. So, CFS Society Sri Lanka is very much thankful to you for accepting our request and having this session for our society. So again, sincere thanks goes out to you and also to the CFA Society for organizing this event. So with that, I think we will now conclude this session. Thanks to the audience also for joining this session. And again, Pankaj, thank you very much.
Thank you so much, Narika. Thank you so much, CFA Society Sri Lanka, for this opportunity and all the wonderful participants and audience. Hope you found this useful, and I'll be available and happy to help as much as I can. Thank you so much.
Thank you very much.